Hi everyone, Happy New Year, and thank you for joining us today for today's webinar on what's selling in 2025 and what isn't. So in case you don't know me, I'm Anil. I'm one of the practice consultants here at Dental Elite, and I joined the 4 years ago now, started off in finance initially, and then transitioned into practice sales 2 years ago. With me today, I've got Zach.
Yeah, so just to let you know, Anil, I think your screen's just gone off. We're back on now. Hi, everyone. You might not know me. My name is Zach Bevins. I'm one of the buyer account managers. I'm pretty new to the team. So if I haven't spoken to you yet, you might well hear from me in the near future. We've got plenty of launches upcoming. And yeah, so this is the second of three in this series of webinars. So next week, we've got Phil Kolodinsky. He's going to be talking about deferred consideration. And then if you haven't caught up yet on last week's, you can find that on our YouTube channel, which is Dental Elite. And that was done by Luke Moore, the co-founder, and Julie Randall, one of the senior practice consultants. And that was on Too Good to Sell, Why Corporates Might Pass on Your Practice. So that's a really good one to catch up on if you haven't as of yet.
Perfect. So to kick things off, let's start with what's actually selling to who. So Zach, if you want to start us off on that.
Yeah, thanks, Anil. So just briefly touching on this, if anyone has any questions, if you please do submit them to us, Anil will run through them at the end of the webinar. Touching on what's selling to who then. So 79 of practices are sold to independent buyers. That goes against the common myth that corporates are acquiring everything. There's an increased number of buyers looking to acquire a second practice, having paid off their existing site, leveraging their financial performances and looking for additional lending to purchase on a second practice. And then we've got a really strong micro consolidator performance from 2024, which we're anticipating will continue into 2025. Next, we can go on to corporate group activity. So it has still softened from the peak of 22-23, but that's down to a couple of reasons. So the cost of debt at corporate level, groups focusing on managing their existing estate, and the reluctance for groups to compete at the same level of micro consolidators, given groups are not sort of gearing up, growing for a mass sale of the whole group. So shall we move on to the next topic?
Yeah, so that's quite interesting then. So 79% to independents, which shows the market's still strong, and of course lenders are still lending. And with it being a green light sector, you know, the money's there to be used for the right practice.
Yeah, definitely.
Perfect. Fine. So what's actually selling then? So I'll be tackling this in three sections, which is based on turnover in terms of the type of practice. So starting off with low turnover stock, where you've got a turnover circa 300k, sub 300k. Typically, what we're seeing in this arena is that NHS and mixed practices lead the way in terms of stronger multiples that are being achieved. So they're very desirable, and I think Zach will agree from an independent buyer's perspective, because especially those that see value in the NHS and guaranteed monthly income from manageable contracts. So these kind of practices with a bit of scope to grow privately are key when it comes to the sub 300k stock. For these, typically funding's quite easy to achieve, and these practices do typically get a high level of interest, but it's all subject to area depending on, you know, where you're located. So more urban areas typically see a better response to these kind of launches. Now, adversely, then you have the private practices at similar turnover. These practices typically tend to achieve a lower multiple, in contrast with the exception of key areas, which will always buck the market trends, you know, hotspots such as London, Manchester or Birmingham, somewhere urban, they typically go against the grain. But the main reason why we do tend to see lower multiples achieved for these type of practices it's all based on the actual risk level and the risk and reward, shall we say, for private turnover businesses. And the main reason is a new owner coming in to buy this type of practice could potentially be worse off quite significantly in the financial sense. So if we're looking at an associate that can gross 300 grand or within that realm, if they were an associate where they continued working for somebody else, they'd earn more after tax at the end of that year without the stress of, say, management and overheads and other things that come with owning this kind of business. Whereas if they gross the same amount, say 300K at a fully private practice as a principal owner, then they also have other costs that they have to factor in. So the staff costs, establishment expenses, and other overheads that typically eat into the profits, which is why there's a difference then within the multiple between a fully private sub 300K practice, turnover practice, and what the mixed and the NHS ones can offer. Section 2 is our mid-tier turnover practices. So anywhere between, say, 500K to 1 million turnover businesses. When we're looking at NHS and mixed practices, these are the most appealing high multiple yielding practices. They're very appealing to independent purchasers because they offer a very good revenue stream for them. And this is also where the micro consolidators also enter the mix. Now, this is only on the basis that there is growth potential within the business. So the potential buyer, if it's a consolidator, can expand the business offering and grow the private through, let's say, surgery occupancy or add in further surgeries. As well as that, if there is a good NHS contract that offers a decent UDA rate as well, that offers additional margin for any buyer looking at the practice within this category, which goes straight to the bottom line, meaning more profits, meaning it's worth it when it comes to debt serviceability and take-home pay at the end of the year. Now, private practices within this bracket, again, the multiple is dependent on the area, as mentioned before when we're discussing the sub 300K kind of turnover stock. But the difference between that kind of practice of that turnover level and where we are now with, say, a fully private practice turning over between 500K to 1 million is that actually this kind of practice offers a potential buyer more profits and a higher yield. And the main reason for that being is you've got other associates within the practice that are also able to contribute towards the income, where they're paid then on a percentage split, and then also the hygienists. So these opportunities then become more favorable than, say, the low turnover stock. And I think looking back at what we're achieving in the current market, Zach, and you might be able to agree on this, but I'd say there's probably an increase in demand for fully private practices within this bracket compared to what we would have seen before, because naturally there has been a bit of a shift, hasn't there, where more people are going away from the NHS to private just to gain that autonomy with trading, especially where there's a plan involved as well. It just offers that same security of what an NHS contract can give, but within the fully private setting, you've just got more control over your costs.
Yeah, I think that's a really good point. One of the questions I get regularly from buyers, which is always good to have as a seller, would be, a really strong existing patient list in that sector, and especially within your age demographics, that it's not all capped out at over 55, over 65. So really having a good mixture of those age demographics as well.
Yeah, no, definitely. And then in terms of section 3 are the high turnover practices where you've got over £1 million in turnover. So over recent times where you've got fully NHS practices that fall under this category, the desirability for these practices did drop. But what we found now over the last 12 months or so, when we're reviewing the type of transactions we're doing and the type of sales that we're achieving, what we found is that actually the NHS practices under this category are in a significantly stronger position. And I'd say the demand returning for these NHS practices is all based on key areas as well, because of course it's no secret where you have got these big contracts or high UDA targets that you have to do. I think the key factor in this is probably recruitment. Well, it is recruitment. So as long as it is in an urban or more key area, so your Londons, your Birmingham's, your Manchesters, it's a lot easier, I would say, to recruit. Is that typically the feedback you're getting as well, Zach, at the moment with your buyers?
Yeah, I think 100%. If you're looking at really high turnover practices, those key areas are what your groups and your micro consolidators are looking at. Having people that are prepared to work as associates, you're going to have to be within certain areas. Now, we did briefly touch on this before we came in here. We had a question about what if I'm not within those areas, and you spoke about some success stories we've had recently and how you went about valuing them, didn't you? And it shows with some of the sales we've had over the past year, and hopefully that will go into 2025, which we're fully expecting now.
Yeah, and that's the main thing. So anyone looking for this kind of practice, it's all about, firstly, how well has the contract been performed. So if it has been consistently performed, that gives any buyer coming into the practice that added comfort of knowing that the infrastructure and the team's there. And then where we've got a strong UDA rate as well, that all goes down to the bottom line. So where you do have those practices, typically, 35, 36 pounds a UDA, I think those are more favoured because, of course, with staff costs going up and with your income being dictated by that NHS contract, it allows that extra buffer and margin to be able to afford those pay increases. And as the DDRB uplifts come in year on year, everyone knows that they can offset that against those costs and still make a good amount of profit at the end of the trading year. I think outside of these key urban areas, the multiples are restricted then in that scenario because it's just a huge risk with these NHS practices and contract delivery, where you haven't got the manpower. I think that's what then puts the frighteners on to people buying those kind of practices, and the rise in associate costs, because to actually get the staff in to deliver that, get the associates into the practice to deliver those UDAs, you're having to then pay a higher amount just to make it attractive enough for them. So those are the key bits when it comes to considering these high turnover NHS practices. But then when we flip it on its head and we look at the mixed and private practices, I'd say this is where the demand is probably the strongest. And this has then transferred into the higher multiples that are being paid within this market class. So I think typical multiples currently are sitting between 7 and 8 times on an associate-led basis. And again, it's area dependent. It depends on the size, the EBITDA, and the growth potential within the business. But the key thing here is where you've got practices that are quite large with decent contracts, high UDA numbers, where you've got more surgeries than at these practices, you're able to then actually dilute the UDA numbers across the practice. And I've seen this model in many successful mixed practices where they're diluting the UDAs over said number of surgeries. They're able to pay slightly less on the UDA rate because the incentive is actually to build a private income at the practice. And that's actually the bonus point for them, the associates, to do fewer UDAs and focus more on the private side. And in terms of corporates, corporates are taking a view on this as well. So in terms of the hotspots, they are actually willing to look outside of those key areas, provided that the performance is there, whether it's mixed or private, because with the way the corporates largely structure their deals, which Phil will be touching on in the next webinar, as you've mentioned, is they want the principal there to be equally invested and continue for a period of, say, 3 to 5 years post-completion typically. And what that then does is it de-risks that opportunity for them. And in terms of the private side within this turnover mix, I'd say it also allows more autonomy to actually offset rising costs, because when it comes to private fee treatments, what they're able to do, of course, is increase treatment prices to offset those rising costs and staff costs. And equally, same with the plan where you've got strong planned practices, what you're able to do is run those plans in quite a profitable and efficient manner, where rather than paying out the full plan at, say, 45 or 50% split, you're able to get the plan paid to the actual practice, and maybe pay the associates on a checkup basis only, as and when the patient attends, and the hygienist then sees the patients for the scale and polishes, and that in turn builds an internal recharge within the business, making the plan more profitable, where you're only paying 20, anywhere between 20%, 25%, rather than parting with 50 straight off the back where the plan's concerned.
Brilliant. Thanks for that, Anil. So we've had a few people join since we started the webinar. If anyone wants us to retouch on anything, as we said at the start, there is a Q&A at the end. So please do pop in any questions you've got, or if you want us to recap anything that we've mentioned in the first 15 minutes. Obviously, I've gone through a bit about what's selling to who already, and then Anil has sectioned off into 3 separate sort of turnover brackets, what is selling currently. And just to finish off this portion of the webinar, before we go to the Q&A, I'm just going to talk briefly about what buyers are looking for at the minute. So questions I'm getting in my role as a buyer account manager on a daily basis. Number one, I would say, and you'll know from me talking to you about it every day as well, Anil, is practices with scope to add further surgeries. That is number one on the list. If that is a no, then people are looking at the secondary question, which is, does the practice have low occupancy within the current surgeries, meaning that they can grow without the expense of adding additional chairs, looking at putting an extension on the practice, or even just trying to move to a different site.
And I think that links into what you mentioned earlier about the independent market, and even those consolidators being able to buy more. As we know, over COVID, there were a lot of bounce back loans at the time where people added a couple of surgeries. We know the post-COVID boom with NHS practices struggling to take new patients on, where those chairs were free. A lot have actually increased their turnover and profits, and they're able to then leverage that when it comes to buying new practices. So, yeah, I think growth is the key for anybody.
100%. 100%. I mean, next point's got to be practices with an untapped private potential. So whether that's adding in implants, ortho, within the practice offering, whether it's just general dentistry on a practice, on a private model in the area in which they're situated in. So location, again, can be key on that point. I would say practices that don't require significant investment, so low amounts of capex needing to go into it, fairly new equipment is always a bonus when someone's going in, and they've seen the price, and you don't want someone to try and think, where can I scrimp and save here? Where can I get myself a deal? If your practice shows that you've put the effort in, you've put the work, you've kept up to speed, it really does help you on that side of things. And obviously the practice being profitable, that it's key for bank funding with interest rates what they are now. Obviously we're hoping that they're going to decrease over time still, but it's key for funding with the stress tests from banks based on higher interest rates. And then the last point from me, I would say NHS practices that are delivering the contract and have a nice, manageable, profitable UDA rate. That's always going to be what a buyer's looking for in the current market, I think.
Yeah, no, definitely. And going back to the profits, like you said, we're in a high interest environment, and the good thing now is the interest rates have come down on the back of the last couple of meetings. We've had 2 reductions. And I think that's where there's been a shift with buyers, where actually we know we were at the peak at one time, and the only way now is down when it comes to the interest rates, provided, inflation's kept an handle on. And we're in a very cash-rich market. So you look at proof of funding documents, bank statements on a daily basis, and the money is there. And I think it's just about that perfect ideal practice. And there's not one size that fits all. Everyone has their own preferences when it comes to the practice.
And if anyone does have any further questions that they'd rather ask separately, feel free to email me or Anil, or give us a call, and we'll happily discuss with you whenever's convenient for you.
Brilliant. Thank you for tuning in, everyone. And hopefully we see you again at the next webinar. Have a good evening all. Take care.
Thank you.